I'm glad to inform you that we've been able to finalize the rate structure today. And the rate structure will be the following. That there will be a zero tax rate in which several items, which approximately constitute 50% of the consumer price index basket, would be included. We don't call it the exempted items, we'll call it the zero rated items. And it was decided that food grain used by common people would be in this category. So that would be zero rated so that its impact in terms of inflationary pressure on common people is the least. The second category was decided as the 5% item. Now the draft proposal had said 6%, finally we converged, and this was a consensus. These are all decisions by a complete consensus, that we decided that it will be a 5% duty, and these will be items of mass consumption which are used particularly by common people. There will be two standard rates of 12% and 18%. Some people had demanded that the standard rate be 18%, but considering the inflation impact of just having one standard rate, we have had two standard rates of 12 and 18%. Now currently, there are several items, particularly white goods and others, which are taxed at an excise rate of 12.5 and a VAT is 14.5, which is 27%. Along with the cascading effect, it comes to anything between 30 to 31% for most of these items. So the present rate of tax is 30 to 31%. There was a suggestion in the draft to bring it down to 26%. But finally, the consensus is that these items, which including the cascading impact, are today taxed at 30 to 31%, will be now taxed at 28%. But with a rider, and the rider is that in this category there are several items which are now being used increasingly as by a very large number of people, particularly the lower middle classes also. So one of the objects behind raising this from 26 to 28 is that the tax will be still below the present rate, but the additional revenue that we will get will be used for keeping the 5% items, the 6 into 5, that is for the weaker sections, keeping food grain exempted, and thirdly, which is equally important, transferring a number of items from this 28% category to the 18% category. Particularly those items which are now increasingly being used by lower middle classes. So for them, a 28 or a 30 or a 31% rate would be higher, so we are transferring them to this. And the additional revenue that we'll get by this 28 would be used to compensate these three categories, so that the GST itself has a progressive character itself. Now there are several items which are taxed at a much higher rate. These are luxury products, in products, demerit goods. These include aerated drinks, these include pan masala, luxury cars, and tobacco products. Taxation, now all these things that I have told you, this was a consensus decision. Taxation on these is much higher than 28%. In fact, tobacco is about 65%, the others are close to 40%. In some case 40 plus minus, it's in that range. So the additional amount to be charged on these products or any other product which fits into this category would be currently charged as a cess. Now this cess plus the energy cess, the clean energy cess on user of coal jointly will constitute the compensation pool. This compensation pool will have a sunset clause of 5 years. This will be reviewed on a year-to-year basis. After 5 years, and in case the compensation is surplus, the GST Council can even, and at the end of 5 years it will lapse. But before that, yearly, it will be reviewed and the Council will decide with regard to the flexibility of this pool. That is, whether it is to be subsumed, not subsumed, reduced, increased, whatever is to be done with this quantum. So the compensation will be funded out of this. Now there is a rough and ready calculation of an amount of about 50,000 crores required in the first year for compensation. If compensation is to be paid through tax collection, its cascading effect will be 1,72,000 crores of tax. Because out of that 1,72,000 crores, 50% would go to the states, 50% will come to the center. Out of center's share, 42% still will go to the states, and then center will have 50,000 left. So paying it out of tax would be hugely burdensome on the consumers. So we decided against that proposal. As far as the cess is concerned, this is not an additional levy. This is an existing levy, so the incidence of this will not be an additional burden of a single rupee. So the states will get compensated and the taxpayers don't have to pay, consumers don't have to pay anything extra. Because these are all cesses / taxes already being paid. As I said, it will lapse after 5 years. And then the council will decide annually how to subsume it or what to do with it. If there is any surplus amount left in this kitty, that would be shared on the basis that the council would decide, the normal sharing formula. We preferred this option of 28% on these 4 items with an additional cess over an alternative proposal which was to have a 40% category, because that would have reduced the cess quantum and would have been unable to fund the quantum. Now that alternative suggestion was made by Kerala, but then the first suggestion found a greater acceptability in the council. So except on this 28 or 40, that over and above 28, whether it should be assessed over and above 28 or it should be assessed over and above 40, except for this, all other decisions are by an absolute consensus. On this, there was one suggestion by one of the members which we noted, but he was also fair enough to say, recognize what the larger consensus was.